Thanks to everyone who registered for the seminar, and good afternoon, everyone. I appreciate the chance for Mike and I to share some thoughts on some of the issues impacting agriculture and the banking industry. I'm going to just kind of touch on these four areas real briefly or real broadly, and really, other than this whole issue around COVID-19, these others have been intertwined in ag banking for many years. When we talk about and think about the impact to agriculture with regard to COVID-19, certainly the reductions in available labor, of course, affect crop and livestock production, as well as processing capacity. And of course, reduced capacity has resulted in lower consumption of farm commodities. So, although these downstream shocks originate outside of production agriculture, we certainly know that the shock has manifested themselves in prices that the farmers and ranchers receive for their crops or livestock, which ultimately, of course, impacts farm income. Of course, last spring and throughout the summer, as states and local health officials set and implemented protocols for industries such as the restaurant, hospitality, and transportation industry, we saw demand for agricultural products shrink. Some examples of this, of course, would be grains such as corn used for the biofuel industry, as well as meat, dairy, and specialty crops used by restaurants and hotels. And generally speaking, when looking at farm operations, historically many will show losses from their farming operations and then look to rely on off-farm income sources for both on-farm and off-farm needs. This chart just shows how off-farm income sources vary by household, and I think it's interesting to see that the majority, roughly 55%, come from wages and salaries of operators, and whether the farmer themselves that have non-farm income or other members of the household. So certainly the loss of wages and salaries earned off of the farm have been impacted due to COVID-19. Lisa mentioned the unemployment rates, certainly, and then that's been a positive note in North Dakota. I think she shared some of these numbers, but the seasonally adjusted September unemployment rate was at about 4.4%, which was down from 5% in August. We look back a year ago in September, the unemployment rate was at 2.4%. So we certainly aren't where we were pre-COVID, but things appear to be improving. So I think this has been shared with the regulatory panel and others, and we know that this virus has touched virtually all sectors of the economy, and the long-term implications really are going to surface in the months and maybe years ahead. With regard to ag real estate, values appear to be holding kind of throughout the region. This is due in part, large part, to record low interest rates that have provided some attractive financing options and opportunities, and also there are investors out there, including those with 1031 exchange opportunities, that continue to show interest. I visited with Kevin Pfeiffer back in August, just to get a sense of what they're seeing. Obviously, they deal with a lot of this on an ongoing, regular basis, and he indicated that in our region, the Upper Midwest, and particularly North Dakota and Western Minnesota, which is kind of a primary area that they focus on, inventory of quality crop and pasture land was relatively flat from a sales perspective, and of course that provides for strong values in maintaining those land values. Some information that I got from NDSU it kind of breaks North Dakota down into 8 different regions, and information going back to 2014 through 2020. It really is everything that you see is fairly flat. There's been a slight increase in what they refer to as the North Red River Valley area in terms of land values, and a slight decrease in the South Red River Valley. But the other 6 regions, for the most part, as I looked over the last several years of this information, it's relatively flat, which is good. One of the things that we, of course, get concerned with in looking at current and future farm programs, along with, of course, commodity prices and the impact that has on land values. And again, we've continued to see balance sheet equity being leveraged to restructure either carryover or shorter intermediate term debt that wasn't able to be serviced properly or serviced the way it was structured. And we know that ultimately this could lead to potentially lead to some involuntary sale of farm real estate, which of course could have some impact on values going forward. I know you heard a lot about from regulatory entities here earlier today, and Lisa gave a great report on the status of banking in North Dakota and from her perspective. But certainly there's been multiple supervisory releases over the past year in the area of credit risk management. Of course, the guidance continues to center on the need to focus on cash flow and repayment capacity, and not an over-reliance on collateral values as a primary repayment source. In the work that we've been doing with regard to loan review and that sort of thing, we've seen, over the last 3 or 4 years, quite a bit of restructuring going on. And so, that in and of itself is concerning as we see these balance sheets continue to be leveraged. But again, from this regulatory perspective, it's really about just understanding that we can't continue to kick that can down the road and leveraging that collateral. We have to be looking at baseline cash flows, stress testing it, and making sure that those budgets are reasonable. And then at the same time, making sure that you're reviewing those secondary repayment sources, which is your collateral, and reviewing those lien perfections and that sort of thing to make sure that documentation is in place. With regard to workout strategies, again, that guidance indicates that from a supervisory perspective, and just as a good practice, restructured loans with documented ability to repay under reasonable modified terms is not going to be subject or shouldn't be subject to adverse classification, simply because there might be some reduced value in some of that collateral. But it all really boils down to cash flow. In the area relative to bank capital, again, Lisa touched on it, our banks are well capitalized, but in general, the guidance really wants banks to be looking at having a capital plan in place. We're seeing that again in some of the work that we're doing, and then making sure that that the plan is being monitored and augmented as needed, being really proactive in the approach as necessary. And again, for the most part, banks in North Dakota and in the area region really are well capitalized, but it's important to have a capital plan in place and then be reviewing it on a regular basis. One of the memorandums that was issued that I referenced was a 2020 from February of 2020 from DFI. And this memo really just provides some clarity on how the department was going to be looking at restructuring or modification of debt used for borrowers who are unable to meet their obligations. And it really boils down to if concessions are being made outside of the bank's loan policy, the department will look for the documentation on how those exceptions are being identified and tracked. So it's important, again, to have that documentation in place. From a liquidity and capital perspective, again, the department wants to see what bank management and ownership is doing and reviewing the impact that distressed credits may have on these issues. Again, stress testing being done, and having a capital plan that's regularly reviewed, and then well documented. And they issued what they referred to as an ag classification policy, and that was designed to establish, again, that certain loans wouldn't be classified if there was good file documentation that supports the loan. Some of the examples of that would be the current year's operating lines, especially if credit file documentation would indicate or indicates that the operating line can be repaid, from crop sales, just normal cash flow, insurance proceeds, government payments, that sort of thing. Also, any guaranteed portion of FHA guarantees or government guaranteed loans, of course, are going to receive a pass rating. And then with regard to carryover debt, it's not automatically going to be classified. Again, what they're going to be looking at is the overall financial condition of the borrower. And then again, secondarily, be looking at the collateral coverage, but primarily that repayment capacity is going to be important, or is kind of the key in that area. And then with regard to inspections, they talk about the current value of inspected and verified livestock and grain inventories would not be adversely classified, or will not be. And what they mean by current is generally no more than 90 days prior to the start of an exam, or with regard to livestock, 180 days for your breeding herds. So from that perspective, they've got some good, I think, good clarification on what the expectations are. With regard to interagency guidance with regard to COVID-19 for banks, again, this guidance is supposed to be sort of a roadmap, if you will, of how field examiners are going to be conducting exams. I know the guys, the regulators this morning touched on this, but it really includes areas related to identifying how effective each institution is in assessing risk around COVID-19, and provides examiners some guidance for assessing and ultimately assigning those components of the CAMELS rating. So whether you've reviewed these documents, I'm sure most of you have, it might be good to go back and look at them again. Consider sharing them. If you haven't already, consider sharing them with your management team, your lending staff, and others in the bank that might be involved in lending or operations related to credit administration, that sort of thing. And also, I think it's important to consider sharing this information at the board level, and making them aware of some of these areas of guidance from a regulatory perspective, and having good, some documentation in board minutes or committee minutes. With regard to credit risk management practices, and this kind of wraps up my portion of this presentation, really just it's about the need for a consistent approach to credit risk management, and kind of broken this into 3 areas of asset quality, underwriting, and administration. Certainly with regard to asset quality, being proactive and recognizing risk and possible exposure is important. And I think for the most part, again, just listening to Lisa's comments, banks are doing a good job of that. In the work that we do in loan review, we don't often come across credits where we're recommending downgrades. We will see those from time to time, but really for the most part, the risk ratings have been, accurate from our perspective in the work that we do. One of the things that we do see from time to time in risk ratings is whether or not that rating that you've assigned to those credits is matching up with the definitions that are being used in loan policy specific to the individual risk ratings, whether it's watch or substandard or whatever it is you're using. We do see situations, particularly when we're looking at credit presentations or annual reviews, and you're maybe using a software program, kind of the old web equity, whatever it's called now, but programs like that that assign scoring systems, and then there will be comments in those annual reviews or in the credit presentations that reflect what the what the framework of those presentations are relative to risk rating. But we do see from time to time where those aren't necessarily lining up with the definitions, if you will, that you're using in your loan policies. So it might be helpful or a good idea to revisit those once in a while, just to make sure that there's a good parallel between the ratings within your credit presentations or annual reviews that you're doing versus the loan policy language. And then with regard to corrective action around the asset quality piece, workout agreements, if you have them in place or are utilizing them, or if you're utilizing covenants, making sure that those documents are signed and dated by the borrower, by your customers, and then also understanding that there are timelines that you have established with those, and we do see from time to time where those workout agreements may have some specific timelines, and then those dates have come and gone, and there hasn't been any documentation or any updated narrative around them. So again, that becomes kind of a challenge in and of itself if you're utilizing them. But having a system in place that's that's administering that the way that they are structured, I think is important. From an underwriting perspective, of course, we know that working capital has been a challenge in agriculture for a number of years. We're seeing in some of the work that we're doing, we are seeing increased credit card debt. We're also seeing more involvement from family. And I mention that primarily because there's a difference between a family member that's wanting to help out financially with no expectation of repayment versus a family member that's got an expectation of repayment, and whether or not and how that's reflected, I should say, on a borrower's balance sheet, because it may not be showing up. And so it's an area that you need to be mindful of. It not only is an issue that affects the balance sheet, but it also affects cash flow if there's an expectation of repayment of some type. And that can be a difficult issue to kind of deal with from time to time when family gets involved in helping a family member financially. But it's important to know what that relationship consists of. And then from a credit administration perspective, again, I think for the most part, we're seeing annual reviews being done, and they vary from very well detailed annual reviews, again, using some type of a consistent approach to those that are just loan officer comments in the comment section. And I think, it's both are fine. I think having a consistent approach is the key to this. I know from our perspective, and you think about it from a third party perspective, being able to pick up a credit file and review that annual review, take a look at it, and within a short period of time, 10 or 15 minutes, have a pretty good understanding of that credit and that relationship. So not having something in place that's consistent can be challenging, and not only externally, but internally, if you're getting new lenders involved or someone else is taking on a relationship that maybe isn't as familiar with it. Most of us in our shops, in your shops, your customers really well, and so sometimes it can be an expectation or an assumption that others do as well. But again, what we've seen is really good presentations, good annual reviews, good credit presentations, and then we've seen others where you've had to dig a little more than just to get an understanding of that credit. And then with regard to problem loan reports, if you're utilizing them, again, we see good documentation in that area, good use of those. I would encourage everyone to incorporate some form of a problem loan report once a credit's been identified as a problem credit and put on the watch list. Having some form of narrative, some form of a consistent approach again is is helpful, and then also reviewing them on a regular basis. Again, it kind of goes back to maybe having some timelines and some dates established within those problem loan reports, and then we've run across them where those dates have come and gone, and it could be a few months or several months later, and there's really no updated information. And so it's a process that requires administrative work and time, but it's an important process to be consistent with it. So with that, I think that's all I had. I don't know if we've got anything else as far as questions, because I don't see anything. So I'll turn it over to Mike at this point.